So I'm super excited that Scott from Andreessen Horowitz is joining us. He is an extraordinary person. It is an extraordinary firm. When you look through the venture capital world, there are only, I don't know how many, but a small handful of funds that have really changed how the industry itself works. And I believe that Andreessen Horowitz is one of them. I know this is a long time ago because they launched in 2009. So for some folks, that's, like the dawn of the world. But before that, there really wasn't a model in venture capital of the kind of hands-on value-added services that feels like just the norm today. They were the first to come at it with a really different approach. And I think everybody upped their game. And they're really, to their credit, really made us all think about how venture capital could be done differently.
I remember when they launched. I think I saw Chris Dixon at that time tweeting about them launching, being like, pay attention type of thing. Like, these guys are real. Obviously, they've had an insane run. And I'm excited to just talk to Scott because I also feel like there's been lots of evolutions and experiments tried with their firm over the years. Like, I remember also maybe early 2010s or 2011, they were writing like crazy volume of 100K seed checks. That was like their sort of experiment with seed at the time. It was like so significant that I think at some point it's sort of like too many companies wore off. Even the signal sort of wore off. As a super early stage investor, also was interested to see like how that early stage approach has evolved, because it's definitely looks a lot different than when they first sort of made a go at it.
Correct. And he can give us all these great data points. But I remember when they did this Skype, I'm not sure it was a take private, but it was a little bit of a take
That's
private,
right.
which was also, I mean, had people just sort of sitting up and paying attention, shall we say. Right. So they've been pioneers multiple times. And
I
he's
forgot
been
about
at
that.
the
That was in their first fund or second. That
Mhm.
was early, right? Yeah, first fund.
So when I started at Sapphire over 12 years ago, I was also, because we were very, very small, we were under a dozen people. I was also helping to look at some of the operational things. And shout out to Scott. He literally gave me time to talk about how one is a COO of a venture firm. And he really didn't, I mean, he didn't know me from a hole in the wall. I share this because some people are just very generous and gracious with their time.
Yep.
And he's someone who's just always been that way. And we can talk about his book, but I see that as another place where he's just been very generous in the sharing. I really think in an honest day like this is information that helps the world be a better place. Why would I sit on it? And just
Yep.
it's pretty amazing.
Yep. Yep. Just like Origins.
Just like Origins. Way to plug Origins. For those who don't know, coming up this year is Andreessen Horowitz's 15th anniversary. So happy birthday. You're almost legitimate to drive. And, and you were employee number one after Mark and Ben. So we think it's safe to say you've been the linchpin in the success and growth of one of the most reputable and game-changing venture firms in the industry. And we thought it'd be cool for folks to hear how you came to be in this place as your introduction to you and to what you do.
Look, this is all a team effort. I've been lucky enough to be part of the ride here, and it's been a lot of fun. But so my real quick background is I was a banker back when being a banker was, I guess, somewhat cool. I don't know, back in the dot-com boom and bust. So that was kind of my first intro really into the technology industry. And I had a happenstance meeting, got introduced to Mark Andreessen and Ben Horowitz when they started LoudCloud back in September of 99. For people who didn't follow LoudCloud, basically we were trying to build what is now Amazon Web Services. And, as both of you know, having been venture investors, or being venture investors, sorry, timing matters. And unfortunately, our timing was probably a little bit off in retrospect. But anyways, I met the two of them. They were starting this company with two other co-founders, and I came home one day and I just told my wife, I'm like, these guys are going to change the world. I got to do this. That was probably the extent of my diligence, quite frankly, and joined them a couple months after it started, and did a bunch of stuff over time there. So I kind of was responsible for a number of the finance functions. And then Ben one day pulled me aside and he said, look, if you're in a company, you have to learn something other than finance. And so he put me in operating jobs that I had no business being in, like running engineering organizations. And I'm not an engineer personally. And I struggled through that, but he was kind enough to kind of keep pushing me along. And then I spent a bunch of time also in the field, running a lot of like pre-sales, professional services, support, those kind of functions. We sold the company to HP. in '07, and a number of us had some obligations at HP through kind of '08 and then a little bit into '09. And the origin of the firm was, Mark and Ben had been doing angel investing with their own capital throughout kind of '07, '08, and then, kind of got together and said, we think there's an opportunity to really do something different and hopefully change the nature of how venture capital is and how entrepreneurship works. And that was really the origin of the firm. And we can obviously dive into that in a lot more detail, but that's kind of, where I've been sitting for the last almost 15 years, as you said.
I'm honestly not sure how one summarizes this, but I know you'll nail it. What's it like to go from the first hire to this, vaulted place in the industry, and your firm has more than 500 people? I mean, how do you summarize that? What's sort of been the experience of that?
It's probably like the same experience that probably a lot of, each of our startup founders go through, which is you go from being on a place where you personally hired everybody, you signed every offer letter, you did every one-on-one, you are, every single person in the hall intimately because, you grew up in a startup environment. And now, as you said, we're like 550 people. And, unfortunately, there are people who I just know in passing. And so it's the excitement of obviously growing the firm and then, figuring out how to organize it and institutionalize it, everything. But it's also, there's also a part of that where you're like, wow, it's, you have to work harder to build personal relationships with people. You have to work harder to kind of make sure that there's communication across the firm. We think of ourselves really more as a company, quite frankly, than a venture capital firm in that respect. And so we've had to set up reporting relationships and, organizational structures and other stuff like that, like you would have in a normal company. And some of that's great because it creates efficiency and specialization. And then some of that is like, okay, I've got to work harder to actually figure out who some of my colleagues are because I just don't interact with them on a daily basis like I used to.
Yeah. So what is your day-to-day today? Maybe it's very different from the past, or maybe it's...
It is very different. Yeah. So here's the simple way to think about it. So for the first 10 years of the firm, we ran everything kind of centrally managed, basically. And so a big part of my job was just managing the investment teams, the kind of what we call our operating teams, which are the teams that work post-investment with our portfolio companies, and then managing all the functions you need, as you all well know, to run a venture firm. So legal, compliance, finance, all those important functions. And then we started about several years ago this process of what we call decentralization. And basically, our view is that we wanted to push down accountability and decision-making much more down in the organization. And as a result of that, essentially what we've done is disaggregated that kind of centralized investment structure into a much more decentralized management team right now. And so the simple way to think about it is we have about 6 early stage focus areas from an investment perspective. And you can think of those each as literally business units inside of Andreessen Horowitz. And so as business units, they have investment making decision authority and they have operational authority. So we disaggregated a bunch of these resources that were centrally reporting into me and pushed them all deeper into these verticals with the hope of getting better alignment, making sure the entrepreneurs were well served, making sure that the investors had both like accountability as well as kind of ultimate autonomy in terms of decision making. And then we've kept very, very few things at the central. So central is only stuff that's like risk or management type stuff that you don't want to decentralize, right? So we don't want to have independent legal organizations inside of each vertical, as you can imagine, because if somebody does something wrong, that obviously has implications for everybody else. And then, things like IR, for example, we've kept central because, I think LPs kind of generally want to interact with us as a firm. But the whole goal really is to, over time, continue to think about everything we can decentralize and push down the organization to do so. And so to answer your question then, what that's meant is it's freed me up to do lots of other fun things that I like doing. So I still spend a lot of time on IR, but we've got a wonderful team now led by a woman named Jen Ka, who has, really built out a team over the years and does, by far the lion's share of the work there. So I spend my time a little bit there. I'm also a GP on the growth team, so I focus on our bio and health areas, which has been a lot of fun. And then the last thing I'm doing these days is we launched a new business that we call a16z Perennial, which is, think of it as a broad asset management business for, high net worth individuals or family offices. And so I've been spending a lot of time kind of getting that off the ground and hiring a team and doing it. So I still feel like I've got the luckiest and the best job in the firm because I get to kind of see everything. And even now I have, more time because I don't have quite the same amount of management responsibilities that I did before.
As you think about decentralizing the firm, how do you maintain the sort of like consistent culture that made the firm great in the first place? How do you make sure that the divisions still want to keep operating on the Andreessen platform? How do you keep what made the thing special while also saying, like, go do your own thing, you know?
So here's how we think about it. And look, we're super lucky because Ben is by far probably, I would say, kind of the key cultural leader in the firm. And in fact, everybody who is onboarded in the company, the first thing they do as part of orientation is they have a session with Ben where he goes through kind of what are the important cultural values that we think about and how do we kind of honor and reflect those inside the organization. So one answer to your question is, look, it requires day-to-day activity, right? So people have to be oriented around it. We have annual reviews. We actually have twice annual reviews where, kind of part of the review process is kind of, are you adhering to and helping develop the cultures? We have all hands meetings. Believe it or not, that's why I say we look like a company where, part of what we do there is when we see somebody going above and beyond, we try to recognize that behavior. So it's no different, I think, than any other large company, which is you have to figure out ways to kind of cascade messages down through multiple layers of the organization, unfortunately. But ultimately, you have to hold people accountable to there are some common things that we all do. And so that's kind of thing number one. Thing number two is I think we've been lucky. Maybe we've, just hired a great set of general partners, but we also recognize that a lot of things happen at the intersection of verticals. And so as you know, for example, we do a lot of, crypto Web3 stuff, and we also have games, and there's no question there's a ton of overlap there. Obviously with AI, AI will permeate a lot of different stuff. And so I think we've managed to kind of hire people and create a culture of people who feel like there's value to them in being part of the whole because they get, to your point, a common culture, a common set of relationships, a common network, a common, hopefully, set of knowledge. Yet we've kind of disaggregated in a way where also they can feel like they have personal responsibility and accountability. Look, it's not an easy thing to do. It requires that we manage it daily, but I think it's really, I give a lot of credit to Ben, who's really kind of make sure as the cultural, barrier carrier for the firm that we really think about that stuff critically.
In every company or startup's life, there's like a couple near-death moments. I'm not sure Andreessen Horowitz ever had a near-death moment, but when you do look back on the last 15 years, certainly Opsware, right, had some.
We had lots of near-death moments.
Near-death moments. So maybe not like that.
Including almost being delisted from NASDAQ at one point.
Yeah. I'm curious, when you look back over the 15 years, what do you feel like maybe were some of the critical decisions? And then if you were to look through over the next 10 to 15 years, what do you imagine are sort of the next set of critical decisions that needs to be made?
Yeah, a couple of thoughts. So first of all, as you well know, also running a firm, the near-death experiences are different because, look, we do have this benefit of having greater visibility on revenues, right, than you do in a startup, right? We don't have to recreate our fee stream every quarter. And so, look, that's a huge benefit, obviously, that, all of us on this call have, is that, we have the ability to kind of have greater visibility. So we never had what I would call like a financial near-death experience. I think the key stuff, though, that could have been near-death experiences was we did a couple things. Number one, in our first fund, one of the very first investments we did was we invested in Skype. As part of the acquisition of Skype out of eBay. eBay was spinning it out at the time. We got all kinds of wonderful, I would say, media coverage of people saying, these guys have gone crazy. They've lost their mind. What are they doing? And look, the good news was we were able to sell that ultimately to Microsoft, 18 months later. And it was a very, very good deal from a financial perspective. So I would say we've had things like that where they worked out well, but certainly, we have always kind of tried to be out on the risk curve. And certainly, as each of you can appreciate, as a first-time fund, my guess is the standard playbook would say, don't do something that might kind of be, considered to be a little bit far outside of the domain of what you're doing. We did tell all of our LPs, we hinted as much as we possibly could that this deal was in the works because it was something that we were working on even before we raised the first fund. But look, I think that was viewed, at least whether rightly or wrongly, it was viewed as something different than maybe, kind of was the core charter of what we were doing. So there were things like that, I think, that were tough. The other benefit we had tremendously was timing. And I think, in all cases, look, timing matters as you all well know in all these businesses. The beauty of the timing was we came out in the beginning of 2009, right? And we all remember how horrible that was. It was literally, we were, Lehman Brothers goes bankrupt in September of 2008. And so you've got this global financial crisis. Of course, you have the famous kind of Sequoia, RIP Good Times presentation, right, that comes out then. So the massive benefit we had, which I think it's hard to overstate how it accrued to our benefit, was we were this new kind of happy, shining beacon with a $300 million fund ready to put capital to work, and we had no legacy portfolio to worry about, right? And again, we didn't plan that out. It wasn't like our plan was not to raise capital in the depths of the financial crisis, although, funny enough, we actually went public as LoudCloud in 2001. We were one of only 2 IPOs that happened that year. Storage Networks was the other one. So maybe Mark and Ben just really are gluttons for punishment, and we're very happy to do that. But it's hard to overstate how important that was because, again, it was a really tough time in the Valley. And, the message, understandably, that a lot of them were getting from venture capital firms was, hey, look, this is not a good time to be doing stuff. And, we had that benefit of kind of being kind of somebody who was interested in putting out capital at a time when obviously others were, understandably so, having to spend more time with their portfolio companies. The last key thing that I would mention, which also, again, was at least at the time controversial, was we believed in the idea of marketing. For a long time, obviously, VCs didn't market directly. They would market indirectly, which is, here's the companies that we backed, that were great, successful companies. And so therefore, if you work with us, maybe you have a chance to be one of those companies. And obviously, as new venture capitalists in 2009, we couldn't compete on that basis because we didn't have the investing track record, obviously, that lots of these other firms had. And so we had to kind of go out and tell the world why we thought we, deserved to exist and why we were different. And we hired a fantastic person, Margit Wenmakers was one of our first hires, who, is just like a, mastermind at, how to kind of position a company. And I will tell you, that was viewed as very, I don't know what the right word is, but just non-couth, I guess maybe is the right word, right? We got a lot of comments from lots of our, frenemies on Sand Hill saying, hey, kind of, this is not the way we do it. And, as you all well know, most of these things get relayed through the LPs. No one actually tells you that, but they tell the LPs what they're upset about, and then the LPs tell us. But, there was a lot of that, which is we were coming from the operating world, right? And our view was, look, in an operating company, you have to tell the world what you do. You have to tell them what your value proposition is, what you stand for, and everybody doesn't have to believe it, but you can't just expect basically, sales magically to happen without telling people what your brand is and what you stand for. And so we felt that was really important. And I think it was immensely important for us to be able to get our message out to a broad entrepreneur base. So anyways, I'm kind of circuitously answering your question, Nick, but they weren't near-death experiences, but I would say there were things that at the time, had they gone differently and had they not worked out, obviously, the history might have been written differently about kind of where the firm is 15 years later.
You all changed the landscape for venture. You thought for yourself, you said, here's how we're going to do it. And you could almost viscerally feel Sand Hill Road perking up and paying attention because it was just different. And to your point, there's a little bit of an antibody reaction back then. I don't know if it's quite the same today. I think venture's done a little bit.
I think that's right. I think it's changed. Yeah. I think that's right. I do think, look, the industry has changed over time. I think some of it, Beezer, I've talked about this offline. Some of it is just, look, the industry has matured in a different way, certainly over the last 15 plus years. But, it's understandable, again, to use your words of like an antibody reaction. I think it's understandable, which is, look, from early 1970s until, mid 2000s, the industry worked in a certain way, and it worked well, by the way. So it wasn't like there wasn't anything necessarily broken, right? There were great firms who, did fantastically well for themselves and their LPs. I think the big thing that changed, at least when I look back in retrospect, and I give Mark and Ben all the credit for seeing this, was once you got to the world of Amazon Web Services and you got to kind of this idea that you could start a company for dramatically less money, and obviously, Nick, you're a part of this story too, it just dramatically changed the balance of power between kind of the traditional firms who were used to kind of the A round being the defining canonical round for how you get involved in a company to all of a sudden, this massive proliferation, of course, that we've seen of whether you call it seed or pre-seed, doesn't really matter, but like something earlier than A round, basically. Mike Maples famously said it, I teach a class at the GSB, and I had Mike the other day. I'll tell you the story. And he's great, by the way. I love Mike, and his partner, Ann, actually was kind enough to do a different class for us. But if you remember, Beezer, you might, like Mike's whole thing was 500,000 is the new 5 million, basically, right? Which is like, you don't need $5 million anymore. And like when he started, I think in, whenever it was, 07, 08 or something, that was his view. And I think that was right. It just dramatically changed the nature of competition because now, as a traditional firm who is used to being first institutional money in, you now, by definition, start to have somebody like Nick or anybody else who's kind of ahead of you in terms of building a relationship. Those types of things, I think, create some, churn in the industry. And, our view was, okay, that's an opportunity for a new firm that hopefully has a value proposition that people find compelling. it's an opportunity for us to try to break into an industry that was otherwise a very staid industry and hadn't had a lot of new entrants. I mean, I don't know if this is true, but Beezer, you may know better than I because you're also a good historian of this industry. But I think other than Seven Rosen, there really hadn't been any new firms that were kind of standalone starts kind of for many, many years in the industry. Because even, like great firms like Benchmark, it was a spin out of Merrill Pickard. There were lots of firms that were spin outs of other firms. And so, look, I think this was kind of one of those inflection points in the industry where we felt like, okay, if there's a time where maybe the industry can take a new venture firm, we thought those changes would potentially create that opportunity.
So just so the audience knows, if in your first fund, you go do a huge M&A transaction and then sell it to Microsoft a year and a half later, you're fine. You're good to go.
This reminds me, I was reaching out to one of our large endowment LPs when I was first getting into the business, and we were having a conversation about distributions, right? And we were trying to figure out our policy, and I was kind of debating, okay, how sensitive are you if we hold something longer after the IPO and other stuff? And he basically said to me, he said, look, the answer to your question, and Beezer might guess who this is, was the answer is just get it effing right. And I think and I think, Nick, that's the right answer to your, hypothesis there, which is, yes, the answer is if you want to go buy Skype within 3 months of closing your first fund, then you better be right that you can sell it 18 months later to Microsoft for a profit. And if that works, you're fine. And the counter narrative, probably is not something you want to think about.
So we are 15 years later. We have a new tough time in the market. You guys were obviously started in a tough time. And so curious, one, what that means for you guys and your strategy, if anything, and then two, for maybe the newer firms that are starting now, new GPs, even much smaller firms, how you would advise them through this period.
Maybe I'll start with kind of the investing side, and then I think kind of the LP side is also relevant here for sure, and Beezer, of course, should weigh in. Look, I think on the investing side, the short answer is I think it's a great time because the reason for that, and I think this was covered maybe on one of your prior podcasts, but if you look at kind of times where you've had technology inflection points coupled with valuation corrections, at least historically, those have been very interesting times for new company formation and ultimately been great, vintages of venture capital years, right? So I kind of think of like 95 as that's when Netscape goes public in August of 95. The early 90s were not great from a kind of valuation stock market perspective. But you get this new thing, you get Netscape and the dot-com boom. And, you get wonderful vintages up until the 2000 vintage, obviously. And then you get a similar thing kind of in the kind of, 03, 04, you're coming off, obviously, the dot-com bust. And that's when you get companies like Facebook and LinkedIn and others like that. And some of that, I think I would call as, I don't know, Web 2.0, maybe for lack of a better word, right? You start to get some of the kind of next generation of internet companies. And then certainly, kind of if you look at, the run we had from kind of 09, 10 until whatever, until recently, huge combination of the iPhone coming out in 07 and being a major platform, certainly SaaS kind of really becoming a major platform. So in general, I think like the combination of inflection, and in this case, obviously AI, at least in our mind, would be that inflection point. Inflection plus valuation correction is good. And so I think overall, and we see that, and I'm sure you all see that in your deal flow too, like there's a ton of great entrepreneurs starting really interesting things. And like always, lots of them won't work. That's just the nature of the business we're in. But there's no shortage of talent, I would say, coming into the industry wanting to do great stuff and trying to figure out how do I make this technological inflection of AI something that can be really interesting. So in that respect, I think it's actually, a really, really exciting time. I mean, look, as you mentioned, Nick, there's no question that the pace of deals is a little bit slower. I think that's probably good, right? Things don't feel quite as frenzied as they did in like the 18 to 21 time period. There's less of, hey, nice to meet you. I have 5 term sheets. Can you decide tomorrow, if you want to invest? And that's not, to say that there's not obviously always competition and entrepreneurs are smart about that, but it just feels like there's a little bit more measured pace of things. As usual, things that are hot are always going to have premium valuations. So, it's not like, some fantastic team that's spitting out of Google on the AI side. It's not like you get some like crazy discount. You pay the market price, and that's just the way the world works. So overall, I think that's good. And I think even on the later stage, where I spend more of my time, as if you look at the numbers, of course, 22 and 23 was a massive deceleration in terms of volume of activities. But I think it's a much healthier environment for 2 reasons. One is just you have less of kind of the, some of the hedge fund crowd, obviously, in that market. We had a stat that we shared with our LPs just to give you a perspective. Something like 60% of rounds in 2021 were led by a hedge fund. And that number, today these days is like sub 10%. And that's not I'm not blaming it's not fair to blame the ills on the hedge funds, but like there are fewer people in the market now, I would say, in that space. And then I think, look, the fact that the CEOs had to live through 22 and 23, as painful as that was, and as many, headcount reductions, of course, that had to happen, which is, incredibly painful to do. I think they have a better sense of how to balance growth with, kind of unit economics and cash generation and stuff like that. So I think there will be good companies that come out of this era. So I think that's where I am right now. I think on the LP side, and Beezer, I'd be curious your view. I do think the LPs are in a more challenge situation, which is, and particularly acute in the endowment foundation world, right, where many of them have, are still over allocated relative to their target allocations. All other things be equal, you'll probably see more secondary transactions, I can imagine. That probably means, therefore, there's less on the whole net new capital commitments that LPs will make, at least in that category of the E&F world. And so, look, that will obviously have to have some knock-on effect in terms of just the sheer growth we've seen in the number of venture capital firms over the last 15 years. I don't know for sure, but it feels like there will have to be some winnowing of those numbers. And look, the counter-availing to that is if you go outside the U.S., obviously you have a whole different picture of many LPs who are much earlier on their venture journey, who are nowhere near their allocation targets. And so I think also for people who want to continue to grow in this market, they may also have to think more about their broader IR strategies and how to think about engaging an audience that, quite frankly, many people didn't spend a lot of time on historically, because I think you do have more of an acute pressure on the E&F world today. So anyways, I don't know, Beezer, if you would agree with that or if you have a different view, but that's my kind of take right now.
I do. I mean, I feel like we're kind of past the denominator effect crunch. So you can take, not that the pain is gone, but that particular source of pain seems to be lessened. Yes. But the overallocation is still a thing. And I was curious, this is a bit of a niche question, but as an LP, I just live in the niches, I think. So I'm going to own it. We found that, I think we're guilty of this, and I definitely know our LP friends ask this. There's a lot more, let me understand what's going on in the portfolio. Yeah. Because you read about all the things of all the predictions and all the term sheets, and the Axios is saying 2024 is going to have all these companies that come back and can't get funded. So as an LP, you're like, wonder how many of those are my companies, right? And it goes to this is like the weirdest silver lining on this. It goes to maybe I'm not as over allocated as I think, because maybe the TVPI will continue to come down, but it's a bit of I don't know what I don't know, so how do I value? And I just hear lots of different aspects of this question around the room, and guide us through it. How do you think about it? And then how do you're masterful at managing this. I've seen you give so many thoughtful presentations. It feels like there's a lot of questions that people have that just aren't fully answered, and maybe they can't be answered yet. I don't know.
Yeah, look, I think that's right. Look, first of all, I'm always skeptical of any prognostications of exactly what's going to happen in the industry, because look, as we all know, any economist who makes a forecast, basically, the validity of that forecast generally has no bearing of what actually happens in the future. And so it's always fun to prognosticate about this stuff, but it's always interesting to see what the track records are. So look, I don't think any of us really knows what will happen in 24 or 25. But I agree with your general point, which is I think people are trying to dig deeper and understand like exactly what's there. And I've always found this very weird in this industry. And, you probably see this too, which is every GP is like, well, I don't want to mark something down because I don't want to upset my LPs. And then the LP comes back and they say, well, we're over allocated to venture. And so like, if you don't mark it down, it's one of these things where I still think the right answer, as with all things in life, as I get older, I realize the right answer is just the simple answer, which is, what do you actually think is the correct number? And, just be transparent about it. And in this case, it's actually, well-serving both for the GP and the LP. If it turns out your NAV needs to come down, then your NAV should come down, right?
For the earlier stage GPs, Fund 1, Fund 2, I think the fear is, I'm going to mark it down. I'm going to help out my LP with their allocation, and they're going to give those dollars to someone else. So I think there's some balance there. I still think I 100% agree, Scott. Like, market to where you think it's actually priced, but I think that's a fear for some of the younger folks.
Okay, so I agree. My but is I'm not saying the GPs should mark things down because the LPs want to mark them down. I think they should mark things down if it's appropriate to mark them down, and I do think. And I agree with you. Yes, there is a risk that there are some LPs who are going to look at that and say, wow, these, Nick sold me something that's different from what he's actually doing. Therefore, I'm going to allocate my dollars away. My impression, and, I have a ton of respect for the LP community, is like, I think they all recognize, even in a fund 1 or 2, like those marks are largely meaningless, quite frankly. And what they care more about mostly is, okay, is Nick doing what he said he was going to do, right? Is he investing in the types of companies we thought, and there are some interim things like, okay, great. Some great firms are following his deals. And I agree that fear exists. I think my experience, at least mostly with LPs, has been that fear doesn't often crystallize in the form of people actually allocating away from that individual. But Nick, obviously, you're maybe closer to this, so you may have a different view.
No, I think that's right. I mean, my honest view is always, my dream would be to keep everything at cost until it's actually realized. Avoid the auditors, just avoid all of the nonsense. It's worth what we put in until someone says it's worth something more with actual cash dollars.
Look, I 100% agree with that. In fact, again, my understanding, this was before I was in the industry. My understanding is that's exactly how the business worked, basically. And then somebody told me, I don't know if this is true, but like Kleiner Perkins had something like, I don't know, they had like Google or something at cost on their financial statements when Google went public, and all of a sudden the auditors were like, this is crazy. Like, there's no way that you're reflecting fair value on this thing. And so now we have all these convoluted things. I mean, we do this thing, it's crazy. We do this like option pricing model thing, which is insane, which is, like effectively run a Monte Carlo simulation on every possible outcome for this company. And look, it doesn't make you any smarter as a GP or an LP with the output of that model. It would be much easier if we could do that. But somehow I think the tide has turned, which is my experience so far with auditors has been they're more likely to ask us to mark something up than they are to mark something down. And so it's so weird how the dynamic in the industry has changed.
Yes. We actually make our jobs harder with the auditors by marking stuff down to where we think it should actually be marked.
Right. You're better off if you either mark it up or leave it, right? Yeah. Look, yes. There's no question LPs are looking deeper into the portfolios now, and that's totally fair, and I get it. And I think some of that is maybe to your point, which is okay. Like maybe my over allocation isn't as great as it was, or maybe it's just like, look, I've done a lot of stuff over the last 5 or 10 years. At some point in time, we have to kind of decide, okay, like are those strategies working or not, and do we need to either mix people up or change from early stage to late stage or whatever the case may be, and do those things.
This is great because I was going to segue into a topic you and I were talking about over email, which I think. I'm going to wedge into this. I'm not sure it fits cleanly, but the sort of what is the right fund size? And I'm in the camp of it depends on your strategy, which is why I'm always crummy on podcasts because it depends, annoys people, but it's true. But I love the fact that we have you and Nick, and you can talk about the difference in fund sizes and strategy because you guys look through different lenses and are going after different goals. And so I was curious when you said you wanted to talk about it, what was top of mind for you? And then I figured we can just play ball with all those aspects.
Yeah. So I love this topic, and I'm not sure if I ever told you this, but do you remember many years ago, Kaufman came out with a report, said something like, we've seen the enemy and the enemy is us, or something like that?
Oh, 100%. It's on like every LP's like,
Okay, got it. Okay. I apologize, but I forget the woman who was running the endowment at that time. But I kind of reached out to her cold, and she and I had this very fun email debate, which was fun, about this whole topic around size. And I think we finally agreed to disagree. But as you know, for the listeners who haven't done it, the basic gist of it, which you see in a lot of the data, is this kind of smaller is better, basically, from a returns perspective. But I don't, at the risk of being boring, Beezer, I think you hit it right on the head, which is, to me, it's not, I think there's a confounding variable here, because it's not, I don't think it's size that matters. I think what the question is what is the opportunity set that you can go after? Do you have the right set of GPs who can win those deals? Do you have the right discipline to not just say, I have a bigger fund, and therefore, instead of doing a $5 million A round, I'm just going to upsize every A round to $10 million. I think there is bad behavior that confounds the results of that. So like I always like to do the thought experiment, which is, okay, if that's true, what if there were 2 venture firms in the entire industry and they each had 50% market share? They would be massive funds, obviously. Whatever, last year we invested $140 billion, right, in venture. So you'd have 2 $70 billion funds. Conflicts obviously confounds us a little bit because they can't actually split the market 50-50, but you would expect that to have the same probably market returns as if you had, a different set of players in the space. So look, I agree with you. Look, we obviously have larger funds, so I'm in some respect talking my own book here. But I think the fundamental question is like, what can you go after? What can you win? Do you have the right decision-making process? And I agree that I think why sometimes you get those lesser good results when you have larger fund sizes is because behavior changes. And if behavior changes because either you do the marginal deal that you wouldn't have done because you feel pressure to put money to work, or, you upsize every deal because you're like, hey, I'm still the same person with the same number of board seats. And and so therefore, instead of Mike's 500,000 is the new 5 million, now 10 million is the new 5 million, basically. I think those are valid reasons. I think, though, at least in my view, is those are organizational incentive problems that you have to solve. And at least our contention is, and so far, I feel good about what we've done is if you solve those problems, then you can avoid the kind of, size is the enemy of returns. So anyway, that's my view. Nick, I would love to hear you argue the counter because I think it's a very valid argument.
I actually don't think I will. I usually do in these situations, but I think
Scott's very compelling.
For your strategy, for your stage, I think there's typically some range of size that probably makes sense for the opportunity set. I'm not a growth investor or a multi-stage investor, so I can't opine on what that right range is. But at least for me, in our firm, we've always tried to say, okay, realistically, and we have some data now historically too, like realistically, what do we think the size of our outcomes are? Realistically, how much do we think we can own of those outcomes? And how do we back into a 5X fund with reasonable assumptions? And if we do better, then great. And then within that range, we typically lean towards being on the smaller side of that range. It just feels like we're setting the bar a little bit lower. We can sleep a little better at night and gives ourselves a little more flexibility to sort of like set the bar low and deliver high.
And some creating some scarcity is always a good thing to do, right?
Yes, and I also think from the fundraising perspective with LPs, we have had a probably marginally easier time by being at the lower end of that range, and I'd rather get it done with people that we really respect and want to work with and just keep our business moving.
Yep.
So I actually don't think I disagree with Scott, oddly enough. I think it's like
many LPs disagree with me, so that's okay.
Like think about the range that's appropriate for you based on what you think are reasonable assumptions around outcomes. And my preference personally, this is probably different for GPs, is just be on the smaller end of that range. But that probably is, maybe that's probably outside the norm.
I think that's right. Look, when I have this conversation with LPs, instead of arguing this, like just look at our individual track record and make a decision. Do you like being an Andreessen Horowitz or not, right? So like forget about the macro question of is smaller better. And then look, I think the things, if I were an LP, or at least what I try to help the LPs understand is, look, I think you have to look at dollars per GP, win-loss ratios, kind of how broad is your, what's your reach basically? Because to me, these are kind of like TAM questions, right? Which is okay. And Nick, I think it's totally consistent with what you're saying, which is, look, at some point, the question is, what is the total addressable market that I think I can win? And yes, it's probably unrealistic to think I can grow my fund size and have one GP, with double the fund size. But if also I'm thinking about commensurately building my GP capacity, and, we have things that we call deal partners, which is basically, we don't use things like associate and analyst words, but that's basically kind of our version of, aspiring general partners, basically. Those things, grow, have to grow commensurately to be able to believe that you can achieve that market coverage. And I think my view is if you do that and then you solve the institutional problem of people feeling like I'm just going to cheat by using deal size as a way to basically compensate for larger fund size, then at least organizationally and mathematically, you should be able to avoid that problem. And look, it's incumbent upon us to do that and demonstrate to LPs we can do that. But, so far, at least, that's the methodology for how we think about it.
I think maybe the more interesting or maybe more controversial question is what is the TAM?
Yeah.
Like to your point, Scott, it's like, are we using historical examples as the right TAM? Actually, does the TAM in the future look very different for,
it's fair,
a myriad of reasons? And I think ultimately, if the TAM is much bigger, your $5-10 billion fund might actually be like, oh, maybe on the smaller side. If your TAM is actually not bigger, then maybe those will be too big.
Yeah. I think it's a great question. And we have historical data. It's obviously somewhat unknowable what it looks like. Our view of the world, not surprisingly, given that Mark wrote this piece about software eating the world, our view is that software will continue to eat the world, and therefore technology as an influencing vehicle, and its impact on GDP and everything else will continue to grow. So yes, not surprisingly, we are on the camp of, we think the TAM is bigger probably than most people give it credit for. And certainly I think over the last 15 years, that has been the case.
I'm going to loop in the techno-optimism work that a16z has been doing to sort of go back to this TAM question, but I'm going to ask a niche question again, because what I was going to say was, I've long suspected there is, and this is why we use the word linchpin, because I do think there is magic and superpower in how a firm is managed. It's very hard to suss out what that is, because I think it's different within each firm. But there's something about the ability to scale and be effective, which I think honestly doesn't work in most places. And that's part of the degradation of returns. As you said, like there's some deals that shouldn't be done or things like that. But you all seem to be somehow just managing through it in a way that is different. How much can you share about the best practices that keep this alignment with the entrepreneurs, with the LPs, with the fund sizes? Because it must be a delicate balance that interplays with incentives and culture. And I don't know how much you can share that's even articulatable.
Yeah, no, I mean, I'll give you, yeah. Let me go back. I think it starts, number one, again, it starts with Ben as like kind of the culture bearer for the firm. And we're very clear on what our culture values are, right? Respect for the entrepreneur and the entrepreneurial process is number one. And, you all know this, it's been reported, but, we have these little, we have some things like, you pay a 10-minute late fee when you show up to meet with an entrepreneur. It's just a simple reinforcement mechanism for you to say, like, an entrepreneur's time is important, and when I disrespect the entrepreneur's time, I should like take out my wallet and give them money. And I love doing it because it gets such a great reaction. In fact, I was in New York a couple months ago, and I was late, so I luckily had I was 10 minutes late. I luckily had $100, which I never have cash on me, but I did. And like the entrepreneur was so taken aback by it, and he didn't want to take it. And I was like, look, I'll tell you what, just like, go put it in, donate it to something or something like, but it was, it wasn't intended to be gimmicky. It was intended to be like a real reinforcement for me and for a way for me to demonstrate to this individual that, look, like I shouldn't be disrespectful by being late. So number one is like, I just think we have a very clear articulation and understanding of cultural values and a very clear, Ben would say this a million times, like, it doesn't matter what you say your values are. The question is, what do you actually do? Right. And he wrote a whole book on it, right. Which is, culture is basically, it's not what you say, it's what you do. And so we have to have a set of management, enforcement mechanisms to reward good behavior, and also to kind of, give demerits when we see bad behavior. So I think that's number one part of it. And I think it works because we've set this up like a company, basically, right? It doesn't work if you are a loose collection of general partners where there's not really a sense of, at some point, you have to have a hierarchy, you have to have a decision maker in the organization. I think that's helped a lot. I think the other thing we've done, I mentioned a little bit, but this kind of what we call decentralization or verticalization, and it really also goes back to the topic we were just talking about, whether, which is, kind of is size the enemy of funds and firms or not. And one of the things that we believe is that a reason sometimes why scale has been really hard to achieve in the venture capital world is because people try to maintain too much centralized control of decision-making and don't disaggregate the decision-making. So to us, the canonical example is you have this centralized investment committee, and not surprisingly, the people who get elected to that investment committee tend to be the people who are the most senior, who've been there for the longest time, and they're obviously very brilliant people. But probably by definition, they are also farther and farther away from what's actually happening at the ground level of, what are the 10 new AI database companies that are out there, right? Like, I mean, I say this all the time, like Mark and Ben, I think they're super smart people, but like, they don't know as much about that to answer that question than Martin Casado or, Anj or anybody on the AI infrastructure team who's doing that. And so to think that you can have a centralized investment committee that is going to opine on decisions, I think that tends to lead to reversion to the mean thinking and, kind of more convergence of outcomes versus dispersion, which is kind of what we want to aspire for in this business. And I think maybe that works in a big private equity firm where, again, you've got very tight risk parameters around things, but where you're trying to do things that look weird or that are outliers or that have, these weird probabilistic outcomes, I think you want to avoid that. And so I think one of the, at least things that we've tried to do is, quite frankly, figure out a way to scale a venture capital firm by avoiding centralization wherever possible and pushing accountability and decision-making down at the individual level. And so far, again, I think that's worked well. And it also goes to the size question, which is it tends to then create the right incentive behavior, because now I'm not just like a GP out of 15 GPs trying to, kind of collectively make money against a large fund that isn't kind of hard for me individually to move the needle, but I have like direct responsibility over my piece. And then the final thing I would just say is you have to then have a compensation system that aligns with that, right? And so again, in our world, we have the rough compensation system is, look, like, you get, obviously, the lion's share of your carry is going to come from the fund that you're primarily involved in, but, you have, pretty good exposure to all the other funds, and every fund, has this cross-sharing of carry, and then funds like our growth fund, for example, that is massively benefits from having engagement with the early stage team, like, there's a very big financial incentive, kind of encourage that behavior. So I just think when all this comes down to it, it's like any other company, which is, do you have a set of objectives? Do you have a way to measure those objectives? And do you have an incentives and an economic system that aligns with those objectives? And I think if you do that, then I think our traditional views of what does a venture capital firm look like over time, can be viewed in a very different framework.
I'm going to switch topics just a bit. I'm interested in like the growing community and chatter around techno optimism. I'm not sure I've fully decided where I am on the spectrum yet. I know Andreessen Horowitz has been, I think, either played a role in this, either personally through GPs. I'm not sure as a firm specifically. And I know you have a significant thesis on American dynamism, which maybe in my brain sort of is related. And so I'm just curious if you can kind of speak to that initiative, both at a firm level or maybe just it's an individual level throughout the firm, and also what it means for your strategy as a firm more broadly.
Yeah, so a couple things. I mean, number one, obviously our founders, Mark and Ben, are founders and entrepreneurs themselves. And so, look, they are optimistic by nature. And you have to be optimistic, as you all know, to be an entrepreneur, because it's, not an easy thing to, start a business where the chances are against you succeeding from the very beginning. So just number one, by nature, we are optimistic. One of our, values is, we believe in the future. We're optimistic about kind of, what the future can look like. So, we do believe that kind of at our core. The big movement right now, if you want to use that term, is, look, we have said this publicly, and Ben wrote a blog post on it, that like so many of the things that we think have made America such a wonderful hub for entrepreneurship, right? Whether it's the immigration system or a favorable regulatory environment or other things, we think some of those are just under assault right now. And not just for our own, it's not just for our own personal financial interests, but we think in terms of economic growth and income inequality and all the other things, that having a thriving entrepreneurial ecosystem in the United States is a very, very good thing to have. And yes, like it's not the panacea for everything. And certainly it's been very concentrated, as we all know, in the super cities. And so it would be a lot better, of course, if it also existed in every other place outside of New York and the Bay Area and LA and, a couple of other markets that's developed. So that's part of also what we believe, and what we would like to do is, find ways in which hopefully we see kind of a greater proliferation of technology and entrepreneurship. So that's the kind of high level. And then our concern is just, we don't feel like right now there really is a voice for that message in DC. There's clearly, you have obviously, look, all the big tech companies, of course, have their, they have their lobbying, organizations, as you'd expect. And so there is a voice, I would say, for kind of very large cap tech, certainly in DC. And then there obviously is a very, kind of a large voice of people who are certainly very, non-tech favorable or non-tech forward. And so we just think it's important, mostly for kind of the future of the U.S. economy, as well as for the entrepreneurship opportunity, to not lose sight of what has made America such a wonderful place, and why for so long it's been the envy of many places where great entrepreneurs who are super smart people want to come and stay here and do stuff. And the idea that we have a system where we have all these great people who come here for an educational perspective, and then somehow we just tell them, okay, now you like have to go return to your home country. Like selfishly, like I'd rather see them, build those companies in the U.S. So that's what it really is. And so we just feel like we're at a time where that voice is lacking, and we're lucky enough to have people like Mark and Ben who kind of obviously have a brand and have the ability to be able to just kind of share a point of view, quite frankly, in DC about what we think is really important for the future of the country.
Are you guys actually pursuing like policy initiatives with congressmen and women? And because it's interesting, I say that through the lens of like crypto. We do a lot of crypto investing. Crypto, I actually think, is starting to do a much better job in the last year or two of engaging with policymakers. Yeah, I'm curious if Andreessen Horowitz is also pursuing that from kind of a broader technology lens.
Yeah. So, as you know, probably, I think in DC, you kind of have to do both, which is you can have your broad overarching story of, okay, entrepreneurialism and, kind of economic development, but then also, look, everything comes down to individual bills that go through individual Congress people that affect their individual districts, right? So you kind of have to do the air game and the ground game basically at the same time. And so, Mark is great, and we're lucky that he has this beacon where he can write a great, interesting op-ed. Obviously, they can get picked up and talked by a lot of people, but then you have to have the kind of ground force behind that. So we have I don't know what the exact number is, but we probably have 7 to 10 people in DC permanently now. And this is all public information. I mean, we are a registered lobbyist in the, kind of in DC. And like their job is to kind of, talk to agencies and talk to Congress people and yes, crypto is an important topic for us. AI broadly, particularly as it relates to regulation, is important for us. Open source is another big one that we're involved in. We're doing more on the bio side, just around kind of the FDA and how do you kind of help fast track potential really interesting kind of therapeutics through things. So those are some of the big picture things that we're working on. But it does require that we actually have a team who is conversant in all these topics and can really help work individually with Congress people on different aspects of legislation.
I want to end with thanking you for joining us and thanking you for writing the book Secrets of Sand Hill Road, which shout out to anyone who hasn't read it. Read it. We still give it to everyone. I give it to the associates. I tell them they need to learn.
Thank you for doing that.
It is just I read it again the other day as a warm up to this, and I just was struck again by the ability to democratize information and just the selflessness with which you shared and the accuracy. And for anyone who doesn't know, I didn't know you wanted to be a singer.
You maybe haven't noticed this, but I have a guitar pick I've been fiddling with a guitar pick in my hand. I'm terrible at the guitar, but I'm trying to get my my tactile skills improved by holding on to my guitar pick.
Well, Nat, you had me at Nashville, so there we go. So we're excited for the post-career option. I might come back to sharing. And one day maybe you'll honor us with a tune.
Yeah.
But to close out and to look ahead for the audience, you wrote this book 5 years ago. It's been quite a ride. Is there anything in the book in particular that you're like, oh, this is really relevant today, or sort of the the guidance to take people forward? Because it was just such a lovely synopsis.
Well, it's funny. So I'll tell you a funny story. There were 2 chapters that almost got axed by the editor. One was about down rounds, and one was about like corporate governance and fiduciary duties and stuff like that. And it's funny, even before 22 and 23, I have to tell you, like, I get more comments about those because people are like, wow, nobody ever talks about this stuff. And that's what I told my editor at the time. Like, you can't axe these things because, like, believe it or not, people care about it. And it turns out. So, yeah, look, I mean, I think all those things that we never talked about, right? Like, what do you do about liquidation preferences? What do you do when you have like this messed up cap structure and you have 10 different venture capital firms who each have a blocking right on you trying to recapitalize the company? And no, it's unfortunate, but like those are the things that unfortunately when everything is going up and to the right, they just kind of work out and you don't think about them. So those are probably the big things I would say, just some of the unintended consequences that can happen when, you kind of, don't realize that, terms can kind of, come back to haunt you at some point in time. That's definitely the biggest area. But no, look, you're absolutely right, which is, look, a lot of things have changed. I'm thinking about writing maybe a new introduction to it or something just to kind of reflect on, obviously, what's happened over the last 5 years. When I find the time to do that, I will try to do that. But there's so many things that have happened, right? I mean, kind of the world is just so different from that book was released in 2019. But yeah, I think that's the biggest stuff that probably gets picked up more that kind of people glossed over when we never had to think about these things.
Well, I was hoping for a sequel, but I'll take a revised version.
I'm not sure I have enough to say. If I have something new to say, I will say it. I'm not very shy about talking, but I got to have something important to say. I'm not sure I can fill a whole book at this point in time, but we'll give it a shot.
Thank you for joining us. It was really quite special and an honor.
Thank you, Beezer, and thank you, Nick. I really appreciate it.